Bismillahirrahmanirrahim. Welcome back to my channel. Welcome to all my subscribers and my viewers. I hope you are all doing fine. As you know, this video series is related to our previous videos. This video will be uploaded in the playlist of business finance. So you can go to that playlist and from there you can watch the previous videos. Okay, without casting any delay, let's start our video. Our next ratio, as I told you in the previous video, we are making a series of videos on financial ratios. So this is probably the last one ratio, which is called market value ratio. So let's not waste any more time and let's start our video. Market value ratios, the final group of measures is based in part on information not necessarily contained in the financial statement, the market price per share of equity. They measure the long-term success of company and shareholders value returns. Market value ratio basically deal on the basis of market prices, right? This measures the long-term success of your company and your shareholders value. How much value your shareholders are actually seeking from your company, or how much value shareholders are attaining from your company. So these are called market value ratios. We will discuss various ratios included in market ratio. So this concept will be very easy for you to understand. First one is earning per share. Earning per share, the formula for calculating earning per share is earnings, which are your net income. You divide your earnings by the share in issues. How much earning you are actually having and how much share you have issued. When we will solve the numericals related to these ratios, then these concepts will be more deep for you and will be more easy for you to understand. But right now, theoretically, at least you have to make bases in your mind. This ratio measures return per share to the shareholder. Earning per shareholders ratio actually measures how much earning your shareholder are actually getting from your company. Then PE ratio, price earning ratio. The formula for price earning ratio is price per share divided by earning per share. What is the price of share and what is the earning per share? The PE ratio is calculated by dividing the market value price per share by the company's earning per share. What is the market value of the share and what is the earning on those shares? So we divide it by the earning per share. A high PE ratio can mean that a stock's price is high relative to earning and possibly overvalued. Overvalued more than its price, actually saying. When PE ratio is high, it means the the high relative to earning and possibility of overvalue is there. A low PE ratio might indicate that current stock price is low relative to the earning, and high says current price is high relative to the earning. So the price earning ratio is simply the net income divided by number of shares. As I told you earlier, this measures how much investors are willing to pay per unit of current earnings. Like from their current earnings, how much they are willing and how much they are happy to pay again. Higher PE ratio can indicate expectation of strong future growth. If price earning ratio is high, it means in the future, the chances are higher, expectations are higher for your future growth. Then market to book ratio. Market to book ratio, formula for market to book ratio is market value per share divided by book value per share. Let me read it and explain it for you. This gives an indication of how successful the company has been over time in creating value for its shareholders. Actually, this ratio uh, shows how successfully your company or how happy the shareholders are from your company, and with the passage of time, how your company has been successful in creating value for your shareholders. In a loose sense, this compares the market value of firm's investment with their cost. Like in layman language, you can say what is the market value of the firm's investment, what is actually their market value, and compare with the cost. A value less than 1 could mean that firm has not been successful overall in creating value for its shareholders. If the value of market to book ratio is less than 1, this is not a good sign. It means your firm is not successful for creating value for its shareholders, right? So it needs to be 1 or more than 1. So it is a better sign. This ratio focuses on historical cost, which are less relevant, however. So main focus of this ratio is on historical cost in the previous cost. Then PEG ratio. PEG ratio, price earning, we need to divide price earning ratio by earning growth rate. The price earning uh, to growth ratio or the PEG ratio is a stock price to earning PE ratio divided by growth rate of its earning for the specified period of time. And this gives an indication of whether the shares are undervalued when PEG is greater than 1 or overvalued when PEG is less than 1 against projected growth rate. Okay. The last one is Tobin's Q ratio. Tobin's Q ratio basically, there is a formula of Tobin's Q. For Tobin's Q ratio, we need to know market value of firm's asset. We need to divide it by the replacement cost of firm's asset. Replacement cost means if you need to replace that asset, what will be the cost for the replacement? This is the market value of firm's